Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Supply and Demand Dynamics. Supply and demand dynamics are the bedrock of economic theory and essential for understanding market forces. These concepts are integral to analyzing how goods and services are allocated in a market economy, influencing pricing, availability, and consumer behavior. The interplay between supply and demand functions as the invisible hand described by Adam Smith, guiding the free market towards equilibrium. This lesson delves into the intricacies of supply and demand dynamics, examining their core principles, influential factors, and significant implications for business model innovation. At its core, the law of demand states that, ceteris paribus, as the price of a good decreases, the quantity demanded increases, and conversely, as the price increases, the quantity demanded decreases. This inverse relationship is fundamental to demand curves, which typically slope downward. Multiple factors influence demand, including consumer preferences, income levels, the prices of related goods, and expectations of future prices. For example, a rise in consumer income generally leads to an increase in demand for normal goods, while a decrease in income causes an increase in demand for inferior goods. On the other side of the equation, the law of supply posits that, ceteris paribus, as the price of a good rises, the quantity supplied also rises, and as the price falls, the quantity supplied falls. This direct relationship results in an upward-sloping supply curve. Factors that can shift the supply curve include changes in production technology, input prices, the number of suppliers, and expectations about future prices. For instance, advancements in technology can reduce production costs, increasing the supply of goods. Market equilibrium occurs at the intersection of the supply and demand curves, where the quantity demanded equals the quantity supplied. This equilibrium price is crucial, as it represents a stable state where there is no inherent pressure for the price to change. However, markets are dynamic, and shifts in either supply or demand can lead to new equilibrium points. For example, if a new technology reduces the cost of production, the supply curve shifts to the right, leading to a lower equilibrium price and higher quantity. Understanding the elasticity of supply and demand is crucial for comprehending how markets react to changes in price. Price elasticity of demand measures the responsiveness of quantity demanded to a change in price. Goods with high elasticity see significant changes in demand with small price fluctuations, while inelastic goods experience little change in demand despite large price changes. Elasticity is influenced by factors such as the availability of substitutes, the proportion of income spent on the good, and the time frame considered. For instance, luxury items typically have high price elasticity because consumers can easily forego them or find alternatives, whereas necessities, such as gasoline, tend to be inelastic. Similarly, the price elasticity of supply measures how much the quantity supplied responds to a change in price. Factors influencing supply elasticity include the flexibility of production processes, the availability of inputs, and the time frame for production adjustments. In the short run, supply is often inelastic because firms cannot quickly change production levels. However, in the long run, supply becomes more elastic as firms can adjust all factors of production. Government interventions, such as price controls, taxes, and subsidies, can significantly impact supply and demand dynamics. Price ceilings, set below the equilibrium price, can lead to shortages as the quantity demanded exceeds the quantity supplied. Conversely, price floors, set above equilibrium, can result in surpluses where the quantity supplied exceeds the quantity demanded. For example, rent controls in urban areas often lead to housing shortages, whereas agricultural price supports can create surpluses of crops. Taxes imposed on goods can shift the supply curve to the left, increasing the equilibrium price and reducing the equilibrium quantity. The burden of a tax depends on the relative elasticities of supply and demand. If demand is inelastic compared to supply, consumers bear most of the tax burden, and if supply is inelastic, producers bear more of the burden. For instance, tobacco taxes are largely borne by consumers because the demand for tobacco products is relatively inelastic. Subsidies, on the other hand, shift the supply curve to the right, decreasing the equilibrium price and increasing the equilibrium quantity. For example, government subsidies for renewable energy can lower the cost of production for solar panels, increasing their supply and making them more affordable for consumers. Market forces are also shaped by external factors such as global economic conditions, technological advancements, and changes in consumer behavior. Globalization has interconnected markets, making local supply and demand dynamics susceptible to international events. For instance, a disruption in the global supply chain, like the one caused by the COVID-19 pandemic, can lead to significant supply shortages and price increases for various goods. Technological advancements continually reshape supply and demand dynamics by creating new products and services and enhancing production efficiency. For example, the advent of smartphones generated immense demand, shifting the demand curve for traditional mobile phones to the left. Simultaneously, improvements in production processes have increased the supply of smartphones, lowering their prices over time. Consumer behavior also evolves with changing societal values and preferences. The growing emphasis on sustainability and ethical consumption has shifted demand towards environmentally friendly and ethically produced goods. Companies that adapt to these changing preferences by innovating their business models can gain a competitive advantage. For instance, the increasing demand for electric vehicles has prompted traditional automobile manufacturers to invest heavily in EV technology, reshaping the automotive market. In conclusion, the dynamics of supply and demand are fundamental to understanding market forces and their impact on business model innovation. The principles of supply and demand explain how prices are determined and how markets reach equilibrium. Elasticity provides insight into the responsiveness of supply and demand to price changes, while government interventions and external factors further influence market dynamics. By comprehensively analyzing these elements, businesses can better navigate market changes, innovate their models, and capitalize on emerging opportunities. The interplay of supply and demand is not only a theoretical concept, but a practical tool for mastering the fundamentals of market behavior and driving business success. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.